If you're a Canadian real estate investor right now and you're still asking yourself whether you should be chasing appreciation or cash flow, I want to spend the next 10 minutes giving you a real answer to that. Not a theoretical one, but a macro level breakdown of exactly what's happening in Canada right now and why, in my opinion, cash flow isn't just the better strategy in 2026, but it's the only strategy that makes sense at any time. And I'm going to go through eight forces, eight things happening in the economy and the market right now that all point to the same conclusion. So stick with me here because this stuff is important. So, in a stagnant economy, do you focus on appreciation or cash flow? And look, I get it. It's a fair question because for a long time in Canada, especially in places like Toronto and Vancouver, appreciation was the strategy. You bought something, you held it, and the market did the work for you. But that game has changed now, and if you're still playing by those old rules, you're going to be in for a rough ride. Let me show you what I mean. So I've broken this down into eight forces, eight things that are all happening at the same time in Canada. And when you see them laid out together, the picture gets pretty clear. So let's start with the one that I think is the most immediate, and that is mortgage renewals. A huge chunk of Canadian investors who locked in mortgages in 2020 and 2021 when the rates were basically at zero, those mortgages are coming up for renewal. And they're renewing at rates that are 200 to 300 basis points higher than they were before. So we're talking about hundreds of dollars more every single month per property. And I did a video on this last week where I talk about some of the ways where you can increase cash flow. So you can watch that as well. It's the one right before this one. Now, if you had positive cash flow going in, that's painful, the 200 to 300 point jump, but it's manageable. But if you're already running thin, which a lot of people were, now you're in negative cash flow territory. And that's exactly what happened in 2025. Small scale residential investors pulled back. Some of them sold out altogether because the carrying costs had spiked and the rent just wasn't covering it anymore. And here's the second thing layered on top of that, which is prices in the major Canadian markets, particularly in Ontario and BC, are either flat or they're declining in 2026. So you don't even get the appreciation backstop to bail you out. Now, you can say, I'm losing money every month, but the property's worth more. Yeah, but that math ain't mathing anymore in those markets. So right away, forces one and two tell you that if you don't have positive cash flow baked in from day one, you are exposed. Okay, now let's move into something that doesn't get talked about quite enough, and that's the macro and policy environment. There's this USMA joint review happening, the Canada, US, Mexico free trade agreement thing. And the uncertainty around that is very real. The Bank of Canada actually flagged it. Businesses aren't investing the way they would normally because they don't know what the trade landscape is going to look like when this all settles out. And when business investment slows down, employment softens. And when employment softens, your tenant pool gets riskier. Now, think about that from the investor's standpoint. Your rental income, your cash flow, is directly tied to your tenant's ability to pay. If the broader economy is uncertain and employment is shaky, you can't count on rent growth to save you. You need the deal to work at the numbers you buy at today, right now. And then there's the population growth, or the lack of it. For years and years, the Canadian investor thesis was partly built on immigration. The more people were coming in and demanding and demand for housing was increasing and the rents were going up. So you were doing well. But that tailwind has really softened. Canada is tracking a net zero population growth in 2026, and we've already this year lost somewhere around 100,000 people in population. So lower population growth means that there's going to be softer rental demand, which means your vacancy risk is higher than it's been in a long time. So if you're buying today expecting that demographic wave to bail out a weak deal, that's not the bet I'd be making right now. Now, all right, now here's where it gets interesting because there are two signals coming from the capital markets, one from the smaller investors and one from the big institutional money, and they're both saying the same thing. First, the small investor pullback, which, and I touched on this earlier, but in 2025, a lot of the individual investors like you and me, people who owned one or two or three properties, they exited the market. Not because they wanted to, but because they had to. The negative cash flow, the increased carrying costs, and the renewal shock just completely caught them off guard. And they didn't have the systems or the reserves or the margins to absorb that, so they had to sell. And look, that's a painful but valuable lesson, right? On the deal is made when you buy it. If the deal doesn't cash flow from day one, you're betting on the market to rescue you, and the market doesn't always come to the rescue. Now, let's flip to the institutional side. And this is a signal I really want you to pay attention to. The big players, the institutional capital, guys like the Boardwalks and the Broad Streets and those big institutional players, they're not confused right now. They know exactly what they want. They want safe haven assets with reliable inflation-protected cash flows, and they buy on that basis. That's the language they're using. Predictable returns, defensive income, cash flow that doesn't depend on the economy having a great year. So when the smart money is moving towards cash flow and the people who got burned in 2025 were the ones who didn't have cash flow, what more do you need? There's the lesson. And then we've got two more forces that are squeezing returns from the supply and the yield side. First is purpose-built rental. There's been a truckload of new rental supply coming online in Canada. Purpose-built rentals that were started 2 or 3 years ago during the construction boom. And that new supply is now landing on the market last year and throughout the rest of this year as well. And it means that vacancy rates are going to start creeping up. And it means that housing providers are competing harder for tenants. It means rent growth has slowed, or in some markets, it's actually pulled back. So those rents that you were seeing at $1,700 may now be only at $1,400 or $1,500. If your model was, I'll buy this and count on a 5 or 10% rent growth per year to make it work, that's a harder case to make right now. And you need to buy so that it works at today's numbers. Build that margin in right now. And then there's the bond yields, but probably not in the way that you've heard it explained before. A lot of financial content out there talks about bond yields and cap rate spreads and risk premiums. And look, I get it. That stuff exists at the institutional level, but that's not your world and it's not really mine either. So let me tell you how bond yields actually affect you as the real estate investor, because it's a lot simpler than people make it sound. The 5-year Government of Canada bond yield is what lenders use to price fixed rate mortgages. That's it. If you're in multifamily and commercial mortgages, they use the commercial mortgage bond, but it's the same idea. They use this 5-year bond, mortgage bond or Government of Canada bond to set your fixed rate mortgage rates. And when that yield goes up, the mortgage rates go up. And when that stays elevated, which it has, your borrowing costs stay elevated, even when the Bank of Canada is cutting its overnight rate. And that's the thing that really confused and caught a lot of investors off guard in 2024 and 25 was the Bank of Canada was cutting rates, right? So everybody's expecting their mortgages to come down, but their fixed rate renewals were still coming in high because the bond yield wasn't dropping at the same pace. Now, if you had that variable rate mortgage, you saw that relief, but the fixed rate mortgages were holding to the bond yield. So the chain looks something like this. You have the bond yield, which stays elevated. Lenders keep fixed rate mortgage rates higher. Your monthly payment is bigger than you expected, and your cash flow is tighter than your number said it should be. And that's the real world impact on that. Nobody needed to understand bond markets. They just knew that their renewal came in at 5.5% instead of 3.5%, and their property stopped cash flowing. That's what this force actually is. And that's why, again, your deal needs to be built on today's financing costs, not where you hope rates will go. And it isn't even a bad idea to build in a 1 or 2% margin to offset that. For a long time, lenders were using what they called the 2% stress test. So when you went to qualify for a mortgage, even if the rates were at 3.5%, they would make you qualify at 5.5%. Okay, so let's bring all this together. 8 forces: mortgage renewal shock, flat or falling prices in major markets, CUSMA trade, uncertainty, near zero population growth, small investor exits because of the negative carrying costs. Institutional capital is chasing cash flow. Purpose-built rental supply capping rent growth. Elevated bond yields are raising mortgage costs. Every single one of these points come to the same conclusion. Cash flow isn't just a preference. It's the discipline that separates the investors who are going to be fine from the ones who are going to be stressed. And I want to be clear about something here. This doesn't mean that appreciation isn't irrelevant. It doesn't mean you shouldn't ever think about long-term value of the property. But what it does mean is that you can't use future appreciation as the justification for a deal that it doesn't work today. That deal has to stand on its own. The cash flow has to be there. Everything else is upside gravy. Now, and I say this as someone who's been in the market since 2003. The investors who've lasted, the ones who've built real wealth over time, they weren't the ones who caught every upcycle. They were the ones who survived in the down cycles and even thrived. They were able to spot the opportunities when everybody else was jumping out, and they were jumping in because they were prepared. And you survive down cycles by having cash flow, by having deals that pay even when the market isn't cooperating. 2026 is rewarding operators, not speculators. If you're managing your properties well, buying smart, and building cash flow, this environment is actually not that bad. There are deals out there. I'm doing deals right now, but you've got to be disciplined about the numbers. If this was useful to you, and I hope it was, do me a favor and hit that like button. It helps more Canadian investors to find this stuff. And if you've got questions or you want me to dig into some specific market or some specific strategy, drop it in the comments and I might use your questions to figure out what to do next. That's it for me today. Thank you very much. I'll see you in the next one.